Hello, everyone. Depending on from where you are joining us, good afternoon, good morning, or good evening, and welcome to this Skybound Capital Investment Insights webinar. We'll also be making the webinar recording available to those who are unable to attend live. My name is Matthew Pierce. I'm speaking to you from Skybound's Cape Town offices, and from where I'll shortly be joining our Chief Investment Officer, Theodore Shu from Hong Kong, and our Chief Investment Strategist, Jabir Sadawala from London. I think we can all agree that the world is a very uncertain place at the moment from a geopolitical perspective, and that uncertainty is reflected in certain macroeconomic trends and where investors are looking as possible safe havens in these times of uncertainty. As a business, our philosophy is focused around consistent, uncorrelated returns, and we remain focused on private market-related asset management solutions. But it's vital to have a firm and regularly updated view on the macro environment in which we operate, and in order to remain relevant in our chosen field. So these quarterly webinars are an opportunity for us to share with you some of the thinking that drives our decision-making within the investment team. And Jabir is going to kick off today before Theo gives us some thoughts around China's role in the current geopolitical and economic environment. So if you have any questions during the course of their presentations, please put them in the chat on Teams, and time allowing, they'll pick out some questions during the session, or as we did on previous webinars, we'll get back to you with any specific questions that you may want to address during the webinar or indeed afterwards. And we do encourage you to get in touch. So without any further ado, I'm going to hand over to Jabir in London to get us started.
Thank you, Matt. Let me just share my screen. And if you can just confirm whether or not you can see that.
We can indeed.
We can see that.
Okay, perfect. Right. Greetings, everybody. Pleasure to be doing this again in terms of our second update. So look, a lot's happened, and I don't think, once again, the world has not disappointed. So I'm going to split this in three parts, and I'll get straight into it. So first of all, let's just begin with the market and economic roundup, because clearly there's still a lot of nervousness out there. And here's a quick snapshot for a select group of financial assets. It's to the end of May. We're coming up to the end of June very soon. But the picture, the trend at least, hasn't really changed. And you'll find that most of the performance has been bunched around in this segment of the asset classes that are selected here. They're not going to be your normal bunch of assets that you would typically select in a portfolio, but they would certainly maybe be components of them through various funds that you might be holding. And then to the right, you've got a couple of outliers that stand out. Gold's done well year to date to the end of May, and so too has copper. And I'll touch on that later on in the presentation. But that's the broad picture. What this chart doesn't show are a couple of what I would call sort of esoteric type plays. One is obviously the world of crypto, particularly led by Bitcoin, and to a lesser extent the likes of Ethereum. And the second category are these AI stocks, particularly, as I'm sure you've read probably on a daily basis, the likes of Nvidia, that are just setting new highs. I think Nvidia now has reached all-time highs, 2 trillion plus or something like that. Now, the significance of that actually feeds into my next chart here. I came across this, which shows the aggregated household balance sheets as at the end of last year. And the point that I really want to make here is for these three regions, which certainly account for a sizable share of the world economies, look at the levels of currency and deposits held by these different countries. Japan is not surprising. It's notoriously been high in terms of holding money in its bank accounts and trying to earn yields wherever it can, because that's largely a function of demographics. And I would argue this is going to increase for the likes of the US and certainly for the euro area. I mean, I bet a lot of people wouldn't have thought that they would expect such a high figure for the euro area, 35%. That's massive. So I look at this and I think, wow, that's quite a buffer to have in your household balance sheet in the event that you're possibly laid off from work, which is not really happening. The working environment looks very good. I just read yesterday how in the euro area, in wage inflation is now soaring. For a selection of countries, they showed year-on-year wage growth rates of anywhere between 5 and 10%. That's well above inflation. So economists would say in real terms, so that's your wage growth minus the inflation rate. In real terms, you're in the money. That's what it means. But this is a very interesting picture to have. And then just sort of right of the currency and deposits, you can see roughly how assets are spread around. So if you're looking at this and thinking, well, God, I mean, does that mean that it's low in the US? The answer is no, it's not low in the US. That's actually surprisingly high for the US. But the US has always been notoriously good at investing in markets. And they've had one hell of a run on markets year in, year out. Even allowing for the likes of 2022 when markets fell close to 20%. The wealth has increased dramatically. So what is the world picture looking like at the moment? And activity generally is measured in two parts. There's one component is called services, and that's what's on your charts right now. And anything over 50, the dotted line there, implies expansion. And all of these are undoubtedly in expansion territory. There's no let up there. In fact, I would argue that the rate of ascent is very much on the up. And that's across these different regions, US, Euro, and China. The other component is manufacturing. That's the making of goods. Factories across the world. Now that has been subdued, and there's a host of reasons why that's been the case. But what I look at when I see this, albeit coming off a very low base, is something that tells me that it's definitely on an upward trend, and that will continue. I see nothing that's telling me that this is actually going to give up. You will find pockets. I mean, we can sit here and nitpick around the world and find sectors in individual countries that are not doing as well as they should be compared to their peer groups, or indeed across sectors. We can always find, potential issues and then just dwell on those. But overall, in aggregate, this is now starting to pick up. And when you think, the way we've come out of COVID, when you look at the level of destocking that took place, when you look at the issues in the globe, particularly in terms of Russia, Ukraine, and what it's done in terms of gateways and corridors for food. There are many, many reasons why manufacturing has been in the doldrums, but it is definitely turning around. Looking at some forward-looking indicators. So one of them, the dark blue line there, compares the orders, the manufacturing orders received by companies divided by the level of inventories. That is definitely on the up. Services, future activity is roughly sort of flat, but it's comfortably over the expansion level, the 50 level. This is a high figure. So services, I would argue, actually is starting to reach altitude. Look at another one, employment. For all the news we hear about the employment markets and will they crack, etc., etc., the fact is manufacturing now is starting to rehire, and services after a blip is certainly starting to pick up again. So there's no indication at the moment that they've lost the plot. And if you look at what Wall Street analysts come out with, and indeed analysts across the globe, actually, particularly in the West, they've been banging on about, there's a limit to what employment markets can take, and you're going to see a reversal. I am not seeing that reversal. I'm simply not seeing it. And when I look at the month in, month out figures, in what I would describe as relatively full employment. It's a miracle to me that we're even digging out the kind of people that that markets can find in order to fill jobs. The question I always ask myself is where the hell are they getting them from? Um, I can only think there are people now starting to come back to the workplace, whether their pension monies are not making ends meet, or possibly many of the long-term sick from COVID. I mean, this is a big deal here in the UK. Something like 500,000 people have been out of work because of that. Um, they're now starting to return to the global marketplace. All of that goes into that particular chart that you're looking at. Input prices and output prices for those same two categories. On the left, you have manufacturing activity. Input prices starting to go up, they're creeping up. I don't think it's anything to worry about just yet. This is a lag indicator, and a lot of it comes down to the recent rise in energy costs that we've had. Output prices, companies, yeah, you've seen a tick up there, but generally companies are absorbing it themselves. That doesn't mean to say that they'll go on doing so. It all depends on that gap between these two. There will be a limit. And if they then pass it on, then you'll start to see an acceleration on this side. So services then will start to go up. But at the moment, they've flatlined. That's good news for central bankers, particularly in terms of interest rates. So no evident pickup there. So in summary, in terms of the global economic activity, inflation is coming down slowly. Activity continues to pick up steadily, and interest rates remain steady with a skew to the downside. In other words, if anything, we're going to see rate cuts. We just don't know when. And that constant debate, that dithering and dathering around when that's going to happen, that creates volatility. You take that out of the equation, markets would be a lot calmer. But the skew is to the downside. So, are there troubles ahoy? Here's the first one. I came across this chart. It's a Deutsche Bank one. I think it's a lovely chart. This is what happened during the Donald Trump era and his entire trade war with China, particularly around tariffs. It's a busy chart, but you can see where everything kicked off big time. It was all around here. It was, within seconds almost of him coming into power. There, he came into power here. Trump election victory right here. And look how quickly it picked up. And we've just had recent tariffs imposed by Europe on Chinese goods to the tune of something like 39-40%. Okay, I think this is going to continue. And it's a give and take game, because tariffs mean more money in the kitty for those that are charging the tariffs. Obviously, it eats into the exporting nations, be it China or anyone else. This is really largely aimed at China. Will it make much difference? I don't think so. Because at the end of the day, Chinese manufacturers are really absorbing a lot of the cost. The biggest issue is around something you'll hear called trade dumping. This is where cheap goods get dumped. We're seeing it in cars and a lot of things, particularly in agricultural world. And a lot of Chinese manufacturers are working on very low margins. And as a result, they can really outcompete their fellow European and, well, generally the Western counterparts. I think this will definitely pick up. I just don't think, based on past precedent, that it's going to be as big a deal as people perhaps think. But it will have an impact on growth, undoubtedly, but just not as big an impact. It's all part of the new sort of geopolitical posturing that's going on around the globe. But we'll see how this one plays out. This is one that's been cited a lot: default rates amongst companies. Now, people look at these recent lines and they think, wow, this is definitely on an upward trend. The first thing I want to point out is that default rates tend to be a lagging indicator. So the last time we had high default rates was back in the COVID era. And if you think about it, you always look for a logical explanation to these things. And there is absolute logic to COVID. We were locked in. We couldn't do anything. So it was natural that, companies couldn't service their debt payments and they started defaulting. No big surprise. And then as soon as the virus died, and it nearly has, I mean, I think I wouldn't say it's been eradicated, but you get the odd case here and there. But as soon as it did sort of more or less die, default rates started to come down. I think on its own, these charts can be misleading. And it's arguable that there is a turning point. Have a look at the next chart. I think this is more interesting because what it does, this one actually breaks down that one specifically just for US high yield. What is high yield? Is anything that's not classified as investment grade, depending on our infamous Moody's, Fitch, and all these S&P characters. I do not swear by them, but we kind of have to live with them. And this is a nice chart. The brown line, you got to look at it in an opposite way. So when the brown line comes down, that's actually earnings improving because it's looking at the drawdown from the previous peak. So as it comes down, that means earnings are not coming down. They're not falling so quickly until, literally they get down to here. Now, in 08, we knew what happened. That was the famous GFC, the global financial crisis. Back here in 2000 or so, that was the dot-com bubble that blew up. And then there's COVID, no surprise there. So when it comes down, so too do default rates for companies. And where we are now is that we had a pickup here. No surprise there. That was largely on the back of the Russia-Ukraine saga and then the inflation that followed through, plus rising rates. Now that we've hit a steady zone, we're starting to see earnings pick up, hence the drop in the brown line. And with it, I would argue the default rates are now going to come down. So this is an interesting point on this chart. Are they going to carry on or are they going to actually roll over? We don't really know that. Based on that chart, we're not quite certain yet. But I would argue they're going to roll over. So I'm not as worried about default rates as perhaps the rest of the marketplace is. When the next big maturing loans come through, which start really next year, then we have to see at what rate companies refinance. If they are to refinance at today's rates, that's going to be trouble, big trouble. But the Fed and co have got plenty of ammunition to bring rates down, and they're not going to stand by and do nothing. So it's a bit of no man's land, but overall, I'm kind of skewed in favor of things being okay as opposed to dire. Earnings, look, they are really now starting to pick up, albeit from a low base. China's still suffering because they're still working on very, very low margins. At some point, that's going to turn around. But China is arguably exporting deflation up to a point. I think that will change going forward. I think they will eventually have to start putting prices through their system. But for now, enjoy the ride. And the beneficiaries are the West, or the Western nations mostly, and some outside of that, EM excluding China. But off a low base, this is picking up, but we're not back to sort of COVID levels as yet. But that's a good sign. I'm only interested in the direction, not the levels. And it supports the activity graphs that I showed earlier. This is what I'm worried about. This is the global debt situation. Our debt levels today are back to, in fact, they're higher than they were at World War II levels. Now, over this period, you had the energy crisis, late 60s, early 70s, and inflation played a big part in eradicating that debt. I thought it would do the same this time around, but central bankers actually decided otherwise. They wanted to clamp down on inflation as quickly as possible. So the reason for this decline in debt levels is down to two things. One is higher interest rates, and the second is what we call QT, quantitative tightening. It's the exact opposite of printing money. And the Americans, the United States has gone a long way in doing this, and they haven't even hit their target yet. They want to reduce their total balance sheet by about 4.5 trillion. That's been the reason for this. Now, the reason this worries me is because the only way you can grow your way out of debt is through growth. And when you look at the split of the world, the only region in the world where you've got decent growth rates is essentially emerging markets and developing economies. And within these, you've got even higher ones. India projected at around 6% or more, China 5% or more, and so on. The average is 4 and a bit. That's still good. For advanced economies, it's a whole different story. We're not going to grow our way out of debt at these paltry rates of growth. And this is very skewed by the United States, because if you look at the next breakdown, look at the US here. That's the only one that's forecast to grow at a really healthy rate of 2.7%. And even that's not going to cut it. You see, you've got to look at debt like a bathtub. Just imagine a bathtub. The water that's in the bath, that is your total debt. That's this column here. The taps, depending on how wide they're open, that's how much you're adding to the debt every year. So you've got two issues here. You've got the existing debt, and you've got the debt that's being added to. And the only way you can grow out of it is through growth. The US is currently growing its debt based on its budget to GDP ratio of negative 6+%. That's horrific. They've got to get to grips with this. And at these rates of inflation, they're not going to eat away at this debt quickly enough. You go down this list, it actually gets interesting, because the countries that we would like to see be in a terrible situation are actually in a surprisingly strong situation. Look at Russia. Total debt only 17%. And it's adding to that by what? Just under 2% per annum. That's pretty worrying. You know, they've got money to spend on the military machine if they want to. And a lot of their GDP, their growth is coming from the military machine right now with their war against Ukraine. So we've got to, they can dig their heels in for some way. So how do you get out of this? What are the implications of this? To me, the answer has to be in productivity for the Western world. There is no other substitute. These are the industrial revolutions that we've had since 1784. We started with coal. It then moved on to gas, basically gas, oil, and and other inputs, steam, for instance, and so on, to help develop the combustion engine. From there, we moved into, and look, that was like 100 years apart. Then we moved into computers and electronics. Look how the time span now shortens. We get into the world of cyber and physical systems. And now I would argue that we're in the world of AI. This is a whole new area that we're moving into. And I think it's been completely underestimated, totally and utterly underestimated. Not only is the rate of development changing, I mean, from 2010 to this area, 2020, I mean, that's what, 10 years? It's ridiculous. We're now getting into this whole world of AI, and at the center of it, the whole chip industry. It's one of the reasons why markets are being driven. I'm not entirely convinced that people understand that there's a logical explanation to it. There's a lot of fashion investing. And over the past 12 months, we've had phenomenal returns, the excitement rally. But actually, when you strip through all of this, I think it's here to stay, because productivity is what AI is all about. It's about being able to do things that humans do, only I would argue better. So this chart, based on the Brookings Institute, looks at the baseline effect, and then the level effect, and then just the level growth. So the baseline is literally as things are. Then you have the level effect, which is taking current AI and developing it into existing markets. And it's a big difference, big increase here. Then you take the level effect. So this is basically this one, and you add the growth effect. Now, the growth effect is anything you want it to be. How big is a market? How big can things grow? Latent marketing. It's creating markets that don't currently exist, and arguably which people can't even think about right now. On that basis, it really shoots up. And by the way, I think this chart underestimates the full-on impact. When a robot can be developed, and I'm not making this up, they exist. The prototypes already exist. When a robot can be developed to make things in a kitchen and flip your eggs for you and then clear up afterwards, then the next stage is implementation. That's what's going to happen. And that with it comes productivity. Let's not get into the world of definitions. The cynics will start to argue about, but how are you defining productivity? Well, we've had this issue with inflation. One country's definition of inflation is quite different to another, but the core of it is quite simple. Inflation is about rising prices. How you define it is pertinent to your circumstances, and the same will be true with productivity. There's another implication here when we talk about AI. The minerals, the metals needed to go into it. Look at the top line, copper, and the importance of copper in making chips. And look at the applications of it, where it's most dominant. Alternative energies, electric cars. Let's just develop on this a bit more. This chart looks just at the demand for copper, and you can see where it's strongest. Electric vehicles, renewables, really staggering. You go into further. Well, how do global copper stocks look? Pretty bad is the simple answer to that. Level of stocks in blue and the stocks available to use in orange. It's not good. Last but not least, how's the discovery of new copper finds going? Bad is the simple answer to that. The discovery drought continues. So these are things to factor in. One other thing around alternative energies. Okay, a lot of talk about this and all this sort of, green talk. Coal has now flatlined. It's actually on a decline. That was the first industrial revolution. Look how quickly that's now starting to die a death, but it's still obviously spewing out. On the right here, you have this chart that shows the level of harmful emissions per unit of all of these. Coal right at the top and different types of coal. And then right down at the bottom, natural gas at 117. That's why natural gas is favored. That's the reason why people are really upping this. Oil now is political. America is becoming such a big contributor to the oil market that I think OPEC has had its day. I'm really changing my view on oil prices now. I think they've had their day. Saudi Arabia just recently had to borrow money in the markets to fund its projects. Until now, they've relied entirely on oil revenues. Times are a-changing. And here, look at the actual ramp up here in terms of alternative energies. Renewables will become the world's largest electricity source within the next 3 years. This was based on 22 to 2025. I'm not making this up. This is the IEA, the Bible of the industry. Renewables and nuclear, and I know there's a lot of debate and dispute around nuclear. I have no issue with nuclear. Will cover all of the growth in global electricity demand up to 2025. And that goes back to the minerals story. So that's basically my presentation. I hope it sort of gets across the key points for me in terms of where we're going. Thank you.
Thank you very much, Jabir, and I'll take over from here. And big thanks because you covered a lot of groundwork that I should have done anyway. And I would like to very much follow up on a few points Jabir just made. Number one is the amount of deposit that you see across these different markets. Let me jump into my conclusion first. I am a long-term bull. Okay, I'm a long-term bull on all the risky assets. Historically, there have been cycles of economy, there have been cycles of market, but every single time we come out stronger. And as long as you have a long time horizon, I'm not suggesting every investor should follow this, but if you are young, if you still have 20, 30 years to invest, then it is more beneficial to be a bull. The second point is economy or the performance of economy is not linearly correlated with the performance of the markets. And I will use China and many of the other markets as examples. So what I'm trying to highlight is there have been a lot of concerns in the market that, okay, we've been living in a good time for too long. When will the market turn? When will the economy enter a recession? And will we be hurt significantly in such a recession? My response is yes. Again, there will be cycles, there will be downturns, people get hurt, but in the very long term, no, I'm not worried about it. Any pullbacks in the market, I look at from a decade-long perspective, any pullbacks in the market will ultimately turn out to be a very good buying opportunity. A not so good example is this year. Any pullbacks in Nvidia share price have turned out to be a good buying opportunity. Again, I'm not suggesting everyone to go buy Nvidia stocks now, but for markets, it really works out that way if you have a long-term perspective. Now, tariffs and the trade war, as well as the more intense tension between or among countries. Now, that leads to a migration of wealth. The migration of wealth, typically, if you listen to the mega theme of Donald Trump, that is move jobs back to America, right? And create more jobs for the Americans. That is a simplified version, but that is so true though. The migration of wealth that I was alluding to really is that some businessman in the world will have to fold his business, but someone else in the world will see more opportunities. Even if you look at Russia, Russia now is churning out 125 new tanks a month. This demand was not required. This demand was not required at all, right? So now let me move on to my own slides. PMIs. Jabir talked about the PMIs already. But what I'm trying to show you is, number one, the trend. So coming out of COVID, everyone was enjoying a boost. China less so. So on this slide, you have blue being US, green being Eurozone, and red being China. Okay, I combine the manufacturing and non-manufacturing in one chart, but I want to show you the trend. So the trend is everyone was very hyped out of COVID, but that hype wouldn't last for too long. So all the PMIs were coming down to stabilize the levels. Okay, so they are not coming down to a bad situation. They actually are only stabilizing or normalizing to the normal way. The other point that I'm trying to make on this slide is really the stability of the Chinese PMI, the two reddish line that you can see here. Again, back to my opening, I was saying the economy is not directly related to the market. The Chinese markets were doing very, very poorly in the past few years. But what I'm trying to show you here is Chinese economy wasn't really tanking. Okay, now the concern is what if China is doing worse and worse going forward? And then my argument is I don't care, because the Chinese market might not be doing too poorly going forward. Now, if I strip out the non-manufacturing, which you have seen from Jabir's slides, if we only look at the manufacturing PMI, again, the red being China. As you can see, China actually currently leads both US and Eurozone. So the real conclusion is that, you know what, the Chinese economy of today is actually not that bad. Okay, it's not necessarily as doomsday as you have seen in most of the news stories. Now, decoupling. I know Matt opened by talking about geopolitical risks, geopolitical tension. I don't want to labor too much on that, but I can give you one conclusion first. A year ago, if you asked me what are the chances of military conflicts in East Asia, my response would have been 0. And a year later, as I'm growing older and more mature, if you ask me the same question, my answer will be maybe 1 to 2%. I still strongly believe the probability of a real war in East Asia today is very, very, very low. But compared to a year ago, the critical change is I moved from 0 to possible. So that will be my conclusion on geopolitical tension. And I'm very happy to elaborate if we get questions on that later in our Q&A session. But let's look at the less severe situation, just the decoupling or the deglobalization that we've been going through in recent years. Jabir used the Donald Trump inauguration or the Donald Trump initiated trade war as a key milestone, and I will follow his suit here as well. I have this chart. The arrow, the red arrow, is when Donald Trump took office and when he started the whole trade war. The blue line is U.S. current account deficit as of GDP. When it goes down, it means it is in deeper trouble. Okay, so U.S. is in deeper deficit when the blue line comes down. And the red line is China's export growth year on year. So what you can see is the same conclusion that Jabir has already summarized for us. Yes, there will be trade war. Yes, there will be the migration of wealth that I just mentioned. But will this be very, very helpful to the nation? Maybe not. Not meaningful, not material. What you can see on this slide is since Donald Trump launched the trade war, the trade balance of US continued to deteriorate. Okay, US is experiencing more deficit as of its GDP. In the meanwhile, China's exports was not really harmed much. In fact, China's exports even accelerated in certain years. So if you look at year 2021, China's export was growing at 30% year on year. Okay, granted, China maybe not directly exporting to US, but China is exporting to Mexico. China is exporting to Canada, and China is exporting to the other peripheral Asian countries who have very good trade terms with US. So what happens is you have heard the terms like friendshoring, reshoring. Yes, those are all valid terms, but they are not depriving China of its exports. They are only moving the China exports to some of these other markets. And that is good enough for China. And that is also why China is not experiencing too much economic hardship as yet. Now, the other big concern that many investors have is with regards to the property situation in China or the property market in China. We've heard about the Chinese property bubble for decades in the past many years, right? The bubble never bursted. Now, I think we have come to this situation where I wouldn't say the bubble have bursted, but the whole market has come to a very, very bad scenario compared to all these previous years. So the market is coming down. But is that necessarily a bad thing? Many skeptics are wondering what the slumping property market will do to all these other Chinese industries, particularly steelmaking, manufacturing, home appliances, etc. People believe if the property market cannot sustain, many of the other industries will suffer. That is not wrong. But what I'm trying to show you on this slide is the blue line being China's second-hand property price year on year. It peaked around 2020. Okay, that's when it started to turn negative. The properties prices are coming down. But I overlay with two more lines, the red line being China CPI, the green line being China recreational CPI. People spend money on things that they don't need to spend money on. If you look at equities, this is typically represented by consumer discretionary, right? So what happened to consumption after property prices have come down? Many people would worry that the whole Chinese economy is coming down together with the property price. That hasn't happened. On the contrary, on this slide, what you can see is the recreational CPI has been outperforming China CPI. Okay, China has been in a deflationary cycle in the past few years, which is an opposite to the developed world. But Chinese spending on the discretionary items have outpaced Chinese spending on staples. What does that mean? The decreasing property price actually is stimulating for consumption in general. And this is not simply a result or function of coming out of COVID. It has lasted to today. So what we are seeing is you should possibly break down the Chinese homeowners into two groups. One is this group who can only afford one place or one property. Their situation has improved because, as I mentioned, China is in deflationary cycle. So Chinese benchmark rates are actually coming down. They're paying less for the mortgages, which is again the opposite to a American homeowner or a British homeowner. But the other group are the group of people who actually can afford to buy more. They're probably holding back now on the additional purchase, but their purchase power in comparison to the property price has been enhanced. So they actually can spend more. And that is positive for Chinese property. Now, I've talked about the positives. Let me share with you possibly the most depressing graph of the day. That is the fertility rate in Asia. And my conclusion for China is it tried but failed. So this is the comparison of fertility rates across major Asian economies in the past 20 years. They were doing okay in the first 15, but they started to tank in the most recent 10-ish years. So if you look at China, the slightly light blue line, it was doing really fine, particularly thanks to the lifting of the one-child policy. Chinese birth rates peaked in a recent decade. That peak was in year 2017, when China produced 16 million newborn babies, and last year that number was 9. But you can see that from this chart, right? All these Asian economies are currently having very, very low fertility rate, which makes reproduction not able to catch up with the dying population. And the worst examples are Korea and Hong Kong, where fertility rate is around 0.7. It's coming down to 0.5 right now. So every other female will have a kid. That's how bad it is. And if we look at the whole world, and I'm comparing the economies of where our colleagues are here, right? So we have large economies, United States, UK, UAE, and we overlay with India. So India obviously is the good guy here. India still has a fertility rate of over 2, but most of the other economies are going down and down and down. But remember, I mentioned economy is not linearly correlated to the markets. So even if we see a decline of population or population growth for now, but it will very soon be population. Even if we see a decline of population or even a decline of economy, that does not mean there will be no investment opportunities. There will be no future for the markets. There will still be. In the very short term, I follow up on what Jabir talked about. Jabir actually quoted only two commodities, and I quote the same two commodities. For the past 10 years, this is, I forget about the copper miners or the gold miners. This is how copper and gold performed in the past 10 years. The purple line being gold and the blue line being copper. So both have had a good run in the past 10 years. Why? Because our economy is not going down. Because China is not going down. China is still producing more. China is exporting more, if you remember some of the previous slides. And gold, that is very much a function of de-dollarization. And I think we will possibly touch more on this in our future quarterly webinars. Remember, I mentioned I'm a long-term bull, right? So I should be more bullish on risky assets. So I'm very bullish on EM in general. I'm very bullish on non-dollar assets. So why am I saying that the recent hype or the good performance of gold in the past 10 years was very much a de-dollarization result? You only need to look at all the central banks. They have been hoarding gold. They were not buying gold before, but everyone is buying gold now. And in the past, they store gold in London. Now everyone is shipping gold back home. If we look at China, China used to hold $3 trillion worth of US Treasury. But what if China really goes into war with US? Is US going to pay back the obligations? No. And that's exactly the key incentive behind all the central banks buying more gold. Will this last for longer? I think so. That central bank buying has already been providing a floor. And it's more interesting in some of these markets, for example, Vietnam and China, where there's capital control. So gold is not just gold. Gold is a key currency. Gold is the only non-local currency that the local investors can get their hands on, right? Because they can't easily get US dollar. They can't get rand. They can't get sterling, but they can buy gold. So gold is the only liquid non-local currency. And that is supporting this big wave of gold buying. With that said, good performance of gold price or gold does not translate into good performance of gold miners. Okay, so those two are different. Now, I talked about the decline of population, right? How do we maybe solve that problem? I mean, does the world still have a future if we have less people? Of course. Jabir talked about AI. Yes, we will have the help with AI. We will also have the help with all the other automation. And let me give you one last example in my section. There will be autonomous driving. So for those who are keen on technology, you probably know there are 4 or 5 different levels of autonomous driving, right? And the level 2 is a relatively basic level. With that said, most of the automakers of today have not introduced level 2 automated driving to most of their cars. And if you read the definition here, you would know that level 2 helps you to stay in the lane, brake your car if necessary, and help you with steering, whereas the level 2 plus will help you with observing your environment and making sure that you're on the optimal route and making sure that the car can take you to the destination without much interference. Why am I talking about this? So this is the real life photo of a Chinese driver and passenger in their car. And as you can see, you don't even need to stay on the wheel. The car will just take you. Many people will argue, yeah, wasn't that the same thing that Tesla have been doing for years? And as long as you're driving a Tesla and you're using the autopilot, you can pretty much achieve the same. That is correct. But what I'm trying to highlight in the next slide is the number of Chinese passenger cars that are equipped with intelligent driving. And these are the penetration levels in the past few years. As you can see, 2 years ago, the penetration was roughly 23%, but as of today, the majority of newly produced Chinese passenger cars are equipped with level 2 or plus intelligent driving. Okay, and this is very, very different from the rest of the world. We talked about tariffs. Jabir mentioned this recently introduced EU tariff on Chinese goods, and that is primarily on Chinese EVs. But what I'm trying to show you on this slide is that this trend of going smart is not confined to EVs. Regardless of how the car is being powered, they can be intelligent, they can be auto driving, and you don't need that many drivers one day. And when I say one day, you probably will think, oh, maybe that one day is 10 years later. Now, let me show you this. This cute little mini vehicle is about the size of a motorcycle. You can see on the background, right? There's no driver whatsoever. It is completely driverless. And this vehicle is being used for delivering food in China. So basically, this is the Chinese counterparts of Uber Eats, but they do not hire people. They use driverless vehicles like this. So it's not a passenger car, but it is already running on Chinese streets. Is this a very rare example? Some companies are just testing out their new gadgets? No. Let me give you another example. This is not food delivery. This is courier, a different company, by the way. What it does is it takes in all the parcels, drives to the next destination, drops the parcel at your doorstep, and they are running on the street. They are completely driverless. So that is China's answer to the decline of population. And shall we be very, very depressed? Maybe not. As I said, there are many, many investment opportunities. The deglobalization is counterproductive. It's very bad, but it's not necessarily bad for companies. It's not necessarily bad for investment opportunities. You need to find companies that can achieve higher aims no matter what. If EU is levying hefty tariffs on Chinese EV makers, the Chinese EV makers are now selling their intelligent driving technology to VW, to Toyota. Actually, VW recently built a new joint venture with one of these Chinese suppliers. So yes, you can prevent these people from shipping cars to your bay, but you cannot prevent cars running in Europe be using Chinese technology. So that's all from me. Back to you, Matt.
Thank you, Theo, and thank you, Jabir. As always, there's so much fascinating food for thought in there. I haven't seen any Q&A or chats on Teams, but being mindful of time, I'd encourage people to send in any queries that you might have for either Theo or Jabir following this. If it stimulated some questions and some feedback that you might want. So please do get in touch. I cannot let Jabir go, however mindful I am of time. He's a self-professed South Africa bull. And we always chuckle about this when he's down in the South African office. But Jabir, just some closing thoughts on what's happened in South Africa in the last few weeks, where today, on this very Wednesday, the president gets sworn in and announces a new cabinet. But with a new government in the offing and a so-called government of national unity, the response from markets has been very strong, which we see in the JSE and indeed in the currency.
Yeah, it has, and it doesn't surprise me. And the only thing that shocks markets from outside of South Africa is when anything happens to potentially disrupt your economic scene. We've seen this in the past. When that whole fiasco happened with the removal of Pravin Gordhan all those years ago, that shook the markets. This is the only thing that traders, certainly over here in the UK, will really focus attention on. And the other thing to note is that in this sort of big, wide world of BRICS, where do you go? Russia's in a mess. A lot of people don't understand India, although they're starting to change their views on that. They don't really still get China. Arguably, that's beginning to change at the fringes. And Brazil's too far away, So, whereas practically every other European understands South Africa through some sort of legacy issue. And these are nice, deep, liquid markets. If you look at the performance of South African markets, when it was all announced that we were moving towards a national unity government, essentially an alliance between the ANC and the DA, to the end or through to end of last week, the rand really rose. I mean, the rand put on something nearly 3%, just shy of 3% against the dollar. It's up even more since. Its sovereign credit rose nearly 2%. Local bonds were up over 5%. And the equity markets in local terms, so that's local rand terms, were up about 1.5%. And that's just positive reaction to what markets believe will be a really good interaction between the two governments. So I think potentially this will continue. I mean, it all comes down to policy now. And they need this alliance for each other's sake, because the ANC has to make up lost ground. We know why the ANC lost. It was essentially everything that went on, in the whole sort of KwaZulu-Natal area where they took their eye off the ball. Then the DA needs this to prove a point. It's going to be stormy waters because the opposition alliance is definitely going to try and do everything they can to bring things down. I mean, I see Zuma's already said he's going to, he wants to be part of the opposition alliance. So they will do anything, and that will mean stirring up the unions and doing anything within their power. But it's great news for South Africa. It's bad news for Brits, obviously, because now things suddenly become more expensive for us. But we'll manage. So yeah, let's watch South Africa closely on this one. It's the first go-to emerging market from a Western point of view.
We look forward to having you both back down here. I mean, it is still, let's be honest, affordable. And if that was an attempt at getting out of paying for your next dinner down here, try again. Jabir, Theo, as always, thank you. And to all of you who have remained tuned in, we really appreciate your presence. And of course, do get in touch. And also, this webinar will be made available as a recording. So if you know of somebody who wasn't able to attend, who would like to receive it, we'll gladly do so. So we look forward to our next quarterly update with Jabir and Theo. But for now, have a great week, and we look forward to catching up soon. Bye-bye.
Thank you, Matt.
Thank you. Thanks, everyone. Thank you.
Thank you all.